Let me ask you something. What if I told you that something as simple and routine as making a bank deposit, something you've done hundreds of times in your life, could right now in 2026 trigger a federal investigation, freeze your accounts, and land you with a penalty that starts at $10,000? And what if I told you that thousands of retirees across this country are doing exactly that activity right now, today, without knowing it's illegal? This is not a scare tactic. This is not clickbait. The rules I'm about to explain to you are real federal law. They are enforced by the IRS, by FinCEN, that's the Financial Crimes Enforcement Network, and by your own bank. And for retirees living on fixed incomes, Social Security, pensions, or retirement savings, the consequences of getting this wrong are not just financial, they can be criminal. Stay with me through this entire video, because by the end, I'm going to give you a clear, step-by-step action plan so you know exactly what to do and exactly what to avoid. My name is Raymond Crivello. I'm a senior analyst and consultant who specializes in breaking down complex IRS regulations, financial compliance policies, and federal banking rules into clear, fact-based analysis that everyday Americans, especially retirees, can actually understand and act on. I want to be very clear before we go any further. I am not your attorney, I am not your CPA, and nothing in this video constitutes legal or financial advice. This content is strictly for educational and informational purposes. For your specific financial situation, please always consult with a licensed tax professional or a certified public accountant. Now, let's get into what is actually happening. Here is the rule that most people think they understand but actually don't. Under the Bank Secrecy Act, which has been federal law since 1970 and is fully enforced in 2026, any cash transaction of $10,000 or more must be reported to the federal government. Your bank does this automatically. It's called a Currency Transaction Report, or CTR, and your bank files it directly with FinCEN without needing your permission and without needing to notify you. Now you might be thinking, okay, fine, I don't move $10,000 in cash. I'm a retiree. I'm careful with money. This doesn't apply to me. And that is exactly where the danger begins, because here's where this becomes critical. The law doesn't just penalize people who move $10,000 at once. The law also targets people who break up their transactions into smaller amounts specifically to avoid that $10,000 reporting threshold. And that crime has a name. It is called structuring, and it is a federal offense under 31 U.S.C. Section 5324. Let me say that again clearly. If you deposit $9,000 today, and then $9,000 next week, and then $8,000 the week after that, even if that money is completely legitimate, even if it's your own retirement savings, even if it came from selling your house or cashing out a CD, if federal investigators believe you broke up those deposits to stay under the $10,000 reporting limit, you can be charged with structuring. Your money can be seized, and you can face penalties that begin at $10,000 and can escalate to federal criminal charges. Now I want to be precise here because accuracy matters on this channel. The IRS Internal Revenue Manual, which is the official operating guide for IRS investigators, specifically defines structuring as, and I'm paraphrasing from the federal definition, the act of breaking up a transaction or a series of transactions with the intent to evade currency reporting requirements. The critical word there is intent. But here is what makes this so dangerous for retirees. Intent does not have to be proven beyond a reasonable doubt in civil asset forfeiture cases. In many structuring investigations, the government can seize funds first and make you prove your innocence to get them back. That is not a theoretical scenario. That has happened to American retirees, repeatedly. Let me give you a realistic example so this feels concrete. Meet Margaret. She's 71 years old, lives in Florida, and recently sold her late husband's car collection completely legally for a combined total of about $60,000. The buyers paid in cash and certified checks mixed together. Over the course of about 6 weeks, Margaret makes several deposits, $8,000 here, $7,500 there, $9,500 another week, because she's nervous about carrying large amounts and because her late husband always said, never put all your eggs in one basket. Margaret has done nothing wrong in her mind. She is not hiding anything. She has full documentation of every car sale, but a bank compliance officer flags her account. A suspicious activity report, what's called a SAR, is filed. Suddenly, Margaret receives a letter from the IRS. Her account activity is under review. The process alone takes months. She has to hire a tax attorney. The stress is extraordinary, and even though she is eventually cleared, she has spent thousands of dollars and months of her retirement dealing with something she never saw coming. This is not fiction. Versions of this story have played out in courtrooms and IRS offices across the country. Now let's talk about the 2026 context specifically, because there are updates you need to know about right now. The IRS this filing season has announced renewed enforcement focus on cash transaction compliance, particularly in categories that affect older Americans. These include large withdrawals or deposits tied to estate sales, inherited assets, business closures, and retirement account distributions. The IRS has also updated its guidance for retirees around what they call unusual financial patterns, which is the language that triggers closer scrutiny. Additionally, for the 2026 tax year, the IRS has expanded its educational outreach specifically targeting seniors around Form 8300, which is the form that businesses and sometimes individuals must file when they receive more than $10,000 in cash in a single transaction or a series of related transactions. If you receive cash, not a check, not a wire, but actual cash, in connection with a business transaction, sale, or service, you may have a Form 8300 obligation. And failing to file that form carries its own set of penalties. But here's what many retirees are misunderstanding. The $10,000 rule is not just about what you do at the bank counter. It applies to how money moves through your financial life in patterns. Banks are required by law under the Bank Secrecy Act to monitor your account for suspicious patterns and report them regardless of the individual transaction size. So even a series of $5,000 transactions can trigger a suspicious activity report if your bank's compliance software flags the pattern as unusual. There are three specific patterns that regularly trigger scrutiny for retirees. The first is repeated cash deposits just below $10,000 over a short period of time. This is classic structuring territory, and banks are trained to flag it. The second is sudden large cash activity in an account that has historically only had small, regular transactions like Social Security deposits or pension payments. If your account suddenly sees 3 large cash deposits in a month, that contrast will register. The third is cash withdrawals followed by redeposits in similar amounts. Even if you are simply managing your own savings across different accounts or different family members, the movement pattern can look suspicious to automated compliance systems. I want to be clear, I am not saying this to frighten you. I am saying this because knowing these patterns allows you to protect yourself. There is one detail most people are missing in this conversation, and it might be the most important thing I say in this entire video. Legitimate money is not automatically protected from investigation. The IRS and federal investigators do not always know the difference between a retiree who sold a car and a criminal who is laundering money, at least not at first. The documentation you keep, the way you communicate with your bank, and the professional guidance you have in place before a problem arises is what protects you, not the legitimacy of your money alone. Let me give you that step-by-step action plan right now. Step 1. Keep a paper trail for every significant cash transaction. If you are selling assets, a vehicle, jewelry, furniture, property, document the buyer, the date, the amount, and keep a copy of any bill of sale or receipt. If the transaction is over $10,000 in cash, understand that a CTR will be filed automatically. Do not try to avoid it. Work with it. Step 2. If you anticipate receiving or depositing large amounts of cash, proactively speak with your bank branch manager before the transaction happens. This sounds simple, but it is one of the most effective protective steps you can take. Tell them the source of the funds. Ask them to note your conversation. Banks have discretion in how they characterize transactions to regulators, and a documented conversation that establishes a legitimate source goes a long way. Step 3. Do not structure your deposits. I cannot say this clearly enough. Do not break up deposits to avoid the $10,000 threshold. If you have $60,000 in legitimate proceeds to deposit, deposit it. Yes, a CTR will be filed. That is not a problem. That is the system working correctly. A CTR is not an investigation. It is a report. What triggers investigations is suspicious patterns, and structuring is the most suspicious pattern of all. Step 4. Consult a CPA or tax professional if you have recently or are about to receive large sums from estate settlements, property sales, business closures, retirement account liquidations, or similar events. The 2026 tax season has specific rules around how these amounts are reported and taxed, and a professional can help you stay compliant from the start. Step 5. Monitor your own financial activity. Request account statements regularly. If you see anything unusual, a hold you didn't expect, a notice from your bank's compliance department, any correspondence from the IRS, do not ignore it. Do not wait. Engage it immediately, preferably with professional guidance. Let's talk about the broader picture here for a moment, because this is not just about one rule or one penalty. This is about the financial security that you have spent your entire working life building. Immigration status, visa categories, retirement savings, whatever arena of life we are talking about, the common thread is that the rules are complex, they change, they are enforced, and the consequences of getting them wrong fall hardest on the people who can least afford it. Retirees are often targeted in these situations not because they are criminals, but because they are outside the workforce. They are less likely to have professional financial advisors checking their accounts regularly, and they often deal in more cash-based transactions than younger Americans: estate sales, downsizing, selling assets accumulated over decades. The IRS knows this, federal enforcement agencies know this, and unfortunately, so do the scammers who now impersonate IRS agents and tell retirees they must pay a penalty immediately or face arrest. Let me be absolutely clear, the real IRS does not call you on the phone and demand immediate payment. If you receive a call like that, it is a scam. Hang up. The real IRS sends letters. If you receive a letter, read it carefully and seek professional guidance. This could affect you even if you think this is not your situation. Because the moment your life changes, a spouse passes away, you sell a home, you liquidate a retirement account, you receive an inheritance, suddenly you are dealing with exactly the kinds of financial flows that this system monitors. And the time to know these rules is before that moment, not after. Here is what I want you to take away from today. The $10,000 rule and the structuring law are not traps designed to catch innocent people. They are anti-money laundering tools. But they are enforced in ways that can catch innocent people who are simply uninformed. Your protection is knowledge. Your protection is documentation. Your protection is professional guidance when the stakes are high. You have worked too hard and too long to let an avoidable compliance issue threaten the financial security you've built. So take these steps seriously. Share this video with a family member, a friend, a neighbor who is retired or approaching retirement, because this is exactly the kind of information that changes outcomes. If you want accurate, fast, and reliable financial policy updates, the kind that actually protect you and your family, subscribe to Raymond Crivello right now and turn on notifications. Tax law, IRS enforcement, banking compliance, these systems are changing rapidly, and staying informed is no longer optional. It is essential. Drop a comment below telling me, have you ever had a bank flag one of your transactions? Or do you have a question about a financial situation you're dealing with? I read every comment and I will respond. Share this video with someone who needs to see it. And if this content gave you value today, hit that like button. It tells YouTube this information needs to reach more people. I'll see you in the next one.